Rob's child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to review its content, discuss its content in relation to the book and how it might relate to what's going on today. This episode's chapter is Chapter 45, Balance Sheet Analysis Concluded. This is the last chapter of the balance sheet section of the book. The first point brought up is discussing balance sheet analysis in terms of safety, and really that's probably the most useful thing on a balance sheet. We're looking for when a balance sheet is stressed, that's when you could expect the most amount of problems. It's one of those things to check to make sure that it's not going to be going bankrupt. I think that's the idea there. And then we go on to discuss some actual numbers. This book largely goes through general terms and doesn't have a lot of specific numbers here for ratios and these kinds of things, but this is one of those places where he does discuss it. And the first point in this issue is, and I'll quote, you need to be careful with especially any indebtedness near maturity that might have refinancing problems. And so, if its current bonds are selling for below par value, below market price, or if interest rates have gone up higher, or you have a combination of the two, then refinancing might be a problem. And that's something good to be highly aware of. And, this pays tribute to Warren Buffett's idea too. When the tide goes out, you see who's been swimming naked or whatever. And so, when the tide goes out, interest rates are going up, businesses are slowing down. Can the business still survive, even though everybody's bonds are likely selling at a discount? And so, it's when business can get, surprisingly even more expensive than you'd think normally, right? So when interest rates go up, of course, bonded debt rates have to go up as well. But in that environment, when business is slowing down, you're going to be having an extra discount on the price of the bonds, which makes the yields even higher. And so that's why these business cycles are so dangerous for smaller companies, high yield, corporate debt, these kinds of things. Anyway, moving on, going back to the main point of the ratios that I was mentioning. He mentions, in the past, this is from a 1940s perspective, second edition. He says a 2-to-1 ratio of assets to liabilities was considered to be standard, and I think he's talking about current assets to current liabilities. And now, as in past 1940, it's actually stronger than that. Today, I find that liabilities often outweigh the assets, or they're more equal, and this is what he actually concludes that an acceptable stock for not too much risk is at least a 2-to-1 current. It's one of two. It either has one of two things, either a 2-to-1 current assets to liabilities ratio, or a 1-to-1 asset inventories to liabilities ratio. So that's pretty interesting. I'm not even sure I see current asset inventories on balance sheets as a separate item. Maybe I'm wrong, but of course, not even all companies operate that way. Not even all companies make their money It's obviously more complicated than that, but with companies that have this being able, I don't know, I guess more than anything, it's worth paying attention to, especially like today, if we ever get into a depression or a recession, to be able to find companies that are clearly going to be continuing to produce real goods. If they're trading below these, if they are even stronger than these ratios here, then it might give you an advantage as far as seeing something that is even more obviously, more clearly underpriced. He doesn't discuss that specifically. It's kind of what I'm extrapolating from this. And then we move on to some things that might, from that perspective, 2-to-1 or 1-to-1 ratios, things that might make it okay anyways. And he says, sometimes you'll have companies with odd fluctuations of raw material costs and can alter or create irregular numbers and still not be alarming. And that's one of the reasons when you're looking at a balance sheet too, it's good to take a look at the history of the balance sheet and where things have been, where they're going, and if they're relying on things like the prices of raw materials, to be aware of what's going on with that market, I think. And then, so yeah, the main point of all of that is, in my mind, is if inventories or assets or liabilities change, really just knowing why is really key. It's important. And how cut and dried formulas really don't tell the full story, and that's an error I think most people make all the time, including myself, when looking at securities and analyzing income statements and balance sheets. When you take a look at the numbers and you just, and that's it. That's the whole story. It's never the whole story. You have to look at the industry. The potential growth that's available or left in the company's future. And yeah, how much has it been expanding? Is it overextended? And I mean, that's the conclusion of this chapter pretty much is all about that one point right there. But we'll get there when we get there. And then next point made that I pulled out of this was to be careful with 1 to 3 year notes and bills due. Again, refinancing risk. If the market sees your company is higher risk and has a discount on the money you're able to borrow, it can, from a stockholder perspective, it can cut into the potential profits massively. And at that point, you're speculating a lot in the success of the company in those cases. But now he mentions next point I want to bring up is how industrial borrowings in 1929 were remarkably small from an absence of commodity and inventory speculation and the sale of lots of stock. So basically, that's pretty straightforward. So, stock prices were going up and up and up, and companies didn't have more. Didn't have more stuff. They weren't making more stuff, and that was probably a part of the whole problem with, what eventually led to the Great Depression right there. Obvious mispricing of securities, and this is something I keep thinking about too, about today, and how as of today in 2023, since 1996, we've never really had a true business cycle. We've never had a wipeout of bad debt, of companies that, it's all in good, it's all with good intentions. You don't want a depression, you don't want a recession where everybody can't make any money anymore, but now we're stuck in a situation where inflation is caused really primarily by too much fiscal spending, and that that's getting a little out of control. And so hard to see how we're going to pull ourselves out of this one. We might need a depression at this point um, in this next cycle, and I wouldn't be surprised if there is one, but I digress. All right, so then we have a point here that, companies basically, the point he made here was that companies sometimes need to cut dividends to refinance maturing debt, and how that's like, that shouldn't give people. Well, what happens with a lot of these dividend stocks is they end up losing a lot of value if you miss a dividend payment. If you're expecting, 30 cents every quarter, and then 40 cents, and then 50 cents, and you've had a 25-year history, and all of a sudden there's no dividend. It's there's a lot of investment funds that are rules based, and they end up forced to sell it, and that can unfortunately make the price go down, even though it doesn't necessarily deserve that. And where he talks about this specifically, to refinance maturing debt, obviously that's an appropriate time to do such a thing. The obvious other solution is to just make sure you're not raising the dividend too quickly, and make sure you have enough surplus so that you don't have to cut a dividend in that kind of situation. Ideally, obviously, with corporate finance, but we have a quote here. Maturing funded debt is a frequent cause of insolvency, and again, especially when the tide's going out, right? Earnings contraction, which can be revenue contraction, which can lead to higher default risk, which can lead to bond discounts, which means when you're trying to sell your debt, no one wants to buy it. People want to buy it pennies on the dollar. It's a problem. It's just a part of nature. It's part of the business cycle. The main takeaway I'm getting from thinking about this with this chapter is that, it's like I said earlier in this video, you're not only dealing with higher interest rates, you're dealing with expanded interest rates because of the higher risk of your company, but even more so, the riskier it is, the higher that gets leveraged up against you. And so, when the tide is going out, it gets extra. It's not just like a little bit dangerous, it's like leveraged danger against companies with especially higher yielding debt, or discounted corporate bonds. So again, the market price of bonds can really kill a company, and then even if they can handle it, refinancing can cost a lot. I basically went over that. And then he has an example where refinancing, one way companies can deal with this is when they're refinancing, attach benefits to the bonds they're selling. Specifically, he mentions rights. So basically the right to purchase stock at a certain price within a certain time frame, so to sweeten the deal or whatever. And there's all sorts of bells and whistles you can attach to bonds to make them more attractive to investors. Next, we have a section that discusses the new practice of long-term bank debt. So apparently, companies, before this book was written, for most of time, you would be getting your bank-funded debt only for current liabilities. So you'd have it maturing every year. You wouldn't have longer-term debt financed from the bank. And he says that, like, in this case, this is all of a sudden people are starting to fund longer-term debt from the bank. And this is an interesting discussion. It's something I don't really think about, right? So you have corporate bonds of a company, and these are typically they can be bought by banks, but they're also, believe, largely purchased by individuals and um, investment companies, these kinds of things. And there's a difference between owing people interest on a bond and the interest owed to a bank. And you can correct me if I'm wrong in the comments about this, but my takeaway from this is that bank debt is likely harder than other kinds of debt. It's I'm guessing it's less forgiving in defaults. If you have your corporate bonds owned by the public and they default on the debt, usually there can be some kind of resolution that takes place. But when it comes to a bank, it's like you know I don't know this but for sure, but I have a strong inclining that lawyers get involved a lot quicker in looking at options to resolve the owed debt quicker. I think that's one of the points here. Again, correct me in the comments if I'm wrong about that point. Then the next section, again with the balance sheet, it's important to take a look at it over time, not just one snapshot. See it the direction that it's been going and where it's headed, and ask why. Are there more liabilities? Why are there more liabilities? Are the assets? I want to say, like, are the assets too much for the liabilities? Why aren't they paying it out? What are they hoping to do with this money? Why do they think they need these extra assets? For example, just like knowing why the balance sheet is what it is the takeaway I get from that section. And then we have a discussion on an example of drawing down surplus to help a company increase their liquidating value versus not having a surplus account. So I guess this is sort of a counterintuitive point, that using up your surplus can actually help increase your liquidating value versus not even having a surplus account. And this extends into this next point, which is that sometimes selling inventory at a loss to increase cash can actually strengthen a company's financial strength. And I believe that this is mostly because of the fact that when companies are valued at their liquidating value, their inventories are typically valued from 50 to 75% of their supposed real value that they'd be able to sell them at. So if you actually go out into the market and sell it, even if it's at a loss, let's say it's 80% or higher than what is calculated in the liquidity liquidity price of the value of those inventories. And so and plus, if you're actually looking to liquidate the company, obviously the inventory needs to be gotten rid of anyway. So that sort of makes sense to me in a lot of ways. And he points out an example with Manhattan Shirt Company. In addition to that too, it's by getting rid of inventories, you're actually avoiding an increase of liabilities, and the liability of the inventory losing even more value, the liability of carrying costs, just like having it, which costs money over time, not just from inflation, but just storage, paying for storage, depending on the situation, but in maintenance, all and everything, So I wanted to point out at this point, this chapter also it talks about book value and liquidating value. And a note I want to bring up is how book value is actually usually higher than liquidating value. And it seems like in this section, Graham is pointing out sort of exceptions to this rule, or at least how liquidating value can, um, be higher than you might think. Basically, I guess. It's interesting. I always kind of thought of book value and liquidating value as separate things. I mean, the same thing, but actually they are different. Liquidating value ends up discounting. You kind of have to have a discount on everything that you're selling because in liquidation you can't expect to get full market price, even though you can say, yeah, the company's building is worth $1 million, but can you sell it today for $1 million? Like, no, you have to assume a bit of a discount for the liquidating value, even though the real book value is actually $1 million. So, and we were he basically mentions here that, like, the biggest point here essentially is that the balance sheet is really needed to supplement the income statement. And so when you're looking at earnings, you really need to do a check on the balance sheet, see what's going on, and have it help you understand the income sheet. And then on 625, the way I understand what he says here is basically you have to guesstimate your losses due to inventory value losses or inventory value decline from sales. And that this is something that you can't really calculate necessarily by yourself, but something you have to sort of guesstimate. Then we have a point here how inventory inflation can make profits look bigger. And that's a good point to make. And this is like, if your company, sells corn and you have lots of corn in your inventory and the price of corn suddenly goes up, then all of a sudden your corn's worth more and you can sell it, you're making more profits. And so it's an area actually to be careful of, because markets typically go up and down, and just because you had that one increase of price of that commodity affecting the value of your current inventory, it doesn't mean that that's going to be continuing into the future. Like, yeah, you got your raw materials dirt cheap, and now you have all this inventory, and that the value of it ballooned up, and now you sell it, and now your profits are looking great, everything's looking peachy. But imagine that reversing. All your raw material price goes up, and then there's, let's say there's more people canning corn or something and selling, and the value of everything can go down there by a lot, actually, when things turn the other way. So that's something I can get out of that. He repeats again how important it is to use the balance sheet to help explain what's going on with earnings, especially regarding inventories. And then the last part of this book is all about comparing American Steel to the corn company. And the way I understand it is that there's really two. It's sort of, I don't know, a tale of two cities or something like that, where the same thing happened in both, but you have very different results. So he looks at the steel company and a corn company, where the steel company had all these profits that increased greatly from everybody needing the country needing more steel for war efforts. And during that same period, corn stayed basically steady. And but what happened was that both companies decided, hey, we're making more money, we're going to expand. And then they bought more production facilities, basically. And we have in the steel case, you know, they bought a new plant, but their production only went up by something like 27% when, you know, it was expected to go higher than that. So they weren't even using it as much as they, sounds like they weren't using it as much as they should have been. And then the profits went up marginally compared to the investment they had made. And so that's an example of a company growing too much. You know, the war's over. You know, steel is just not as hot anymore, not as, and so, you know, that from an investor standpoint, that may have been a mistake. But on the other hand, the corn company did the same thing. They increased their production, and they were able to actually increase their profits by a lot, by a large amount. And so, you know, the main takeaway from here, he doesn't even talk about it really, but, you know, this is obviously largely a consequence of industry difference. You know, what's going on in industries. And, you know, that's something I always like to point out, that I talk about a lot, is the uranium industry, and how, you know, we're drawing down the supply. There's not enough being made, and the world's currently building more nuclear power plants. And so this is like one of those areas that I think will do very well until we have overproduction of uranium, and then, you know, and then it swings the other way. It swings both ways. But you know, that's an exciting expanding area, I believe, right now in 2023. So yeah, you know, and another way to look at this is to be careful with, you know, cyclical types of investments, things that can go up and down, versus, you know, corn that people are, you know, I mean, and then another thing to consider today is, you know, population growth. You know, are we going to be consuming that much more corn in the future? If you don't have more people, you're not going to be eating more corn. I mean, there's simple things like that. But anyway, I digress. Point being, always consider future demand of a company's goods and services. You know, whatever a company is producing, you always have to consider, okay, well, what is the future demand going to be, and why? So, you know, and taking a look at specifically demographics today in the United States, you know, this, I've heard people talk about, you know, investing in the medical industry and hospitals, these kinds of things, and, you know, the more I think about that, the more right that probably is. Although the valuations right now may have even gotten overextended. But yeah, so that's that chapter. We have finally finished this part of the book with balance sheet analysis. And that is chapter 5. Hope you enjoyed. Rob's Child.